Okay, just wait for a couple more seconds. A couple of people are joining. Okay, hello everyone and welcome to our March webinar. We have got Nwabisa with us today to talk about the mortgage landscape. She's aiming for about half an hour presentation, including a dedicated time for some questions and answers. So as usual, if you do have any questions throughout the presentation, or if there's anything you'd like to bring up or to be clarified, if you just pop it over in that Q&A box to your right hand side, we will go over that at the end with Nwabisa. As usual, if you have 30 seconds at the end of the presentation, I'm going to be putting a survey up. If you could leave some feedback for us, obviously that would be greatly appreciated. We have got a section on there just to see if anyone's got any suggestions that they would like to be included within our webinar series. Other than that, Nwabisa, I will let you take it away.
Good morning, everybody. Welcome to today's webinar. I am Nwabisa. I'm a mortgage advisor. So I've been doing that for about 3 to 4 years now with Ascot Wealth Management. Just some pre-webinar disclaimers. So this presentation is for information purposes only and does not constitute financial advice. Ascot Wealth Management is authorized by the Financial Services Authority. Rates and sort of the legislation may change. So it is good to still seek financial advice. So some of our business expertise, we help with first-time buyers, obviously new residential purchases and buy-to-lets, development finance, as well as limited company mortgages. So if you do have any questions, please do reach out to me. In today's webinar, we'll be looking at the general market update, so what we've seen in the sort of mortgage interest rate market as well. We'll talk a little bit about first-time buyers and some of the challenges that they're facing, and house prices right in the end. So to start off our webinar, we'll be looking at sort of the current economic landscape that we are in. Obviously, this is quite an important part of how this affects mortgage rates in the market right now. We've seen that the Bank of England has kept the base rate at about 5.25% since August. So we've seen a little bit of stability in the market. This is largely due to sort of inflation dropping down to sort of 3.4% on the year currently now. So overall, there has been a general positive uptake in terms of customers and lenders and the market overall. We are expecting the Bank of England to do some rate drops this year. But again, that is sort of a longer process than most people would actually think it is. And we want to talk about sort of the economic, or what that means for the mortgage market going into this year or into the rest of the year. So the monetary policy decided to keep the rate at 5.25% last week, as you would have seen the announcement. We have seen a large drop, especially from the high inflation rates that we've seen over last year. But still, they want to sort of aim for that 2% in inflation to go down. And some of the key concerns that they have cited in their reasons for keeping the base rate where it is in terms of wage growth, still some energy bills and sort of fuel duty freeze might still be able to drop inflation this year, but they still feel that that is still to be seen and is not sort of a stable place right now, especially with global oil costs rising. So they still feel that we might see some price increases, especially also linked to the shipping disruptions happening in the Red Sea. And so they've given the cautionary message to the market as much as we are expecting rates to decrease, sort of the rate or the pace at which that happens is still to be seen, and they want to sort of move cautiously. So this sort of takes us into a place where the base rate projections are now seen only to be possibly changing in June. There have been talks of a May decrease, but again, as they've said, in those sort of cautionary, the way that they want to move, likely the first decrease would be at around June. The market is still sort of at a place where it's wanting to price in for the rest of the year. We may or may not see a decrease in September, but the overall sort of aim is to hopefully get to a base rate of about 4.5% by December. Again, I will emphasize that these are not guaranteed. We may see that the Bank of England might say, the Monetary Policy Committee might say, think that certain instabilities in the market that might cause them not to make these decisions. But overall, this has been a positive change from what we've seen last year going into this year, and definitely that has been reflecting in the markets. If we look at average interest rates, from what we've seen over the last 6 months, definitely has decreased. If you look at that high peak of that blue in sort of June 23, that slowly started to come down. People can now sort of expect interest rates to be in that 4% range. We did have a very good rally at the beginning of this year where we actually started seeing rates below 4%. And some of my clients were able to take advantage of that drop in the market. But again, because of how cautionary the Bank of England has been in slowing down in terms of decreasing the base rate, that those rates have creeped up a little bit now, sort of pricing in that more cautious view of the market amongst, or even though a lot of optimism has been seen. We can see that even though we're sort of seeing these positive talks or statistics in the market and the rates have started to come down, people are still definitely feeling the pressures in terms of inflation. Mortgage approvals have definitely gone down. As you can see, those numbers that have been sort of recorded especially towards the end of last year. So this is in a sense a good thing, because obviously what the Monetary Policy Committee set out to do is working in the market currently. Inflation is coming down, but the cost of living, or the cost of mortgages on top of everything else, is being felt by the customer. And so we see that affordability has been a massive challenge and will probably continue to be a massive challenge, as in this next slide here, I've shown the number of people sort of coming off their fixed rates, most of which were probably still in that 2% or below 2% margins, sort of having to come on to mortgage repayments that will significantly be higher. And so obviously people, on top of the cost of living crisis, sort of want to know, well, what would be what does the next 2 years for me look like in terms of fixing a new product? I've spoken to clients who maybe say, should we wait a little bit longer? Just because of the fear of, getting locked into those higher rates. But what I still sort of discuss with clients right now is lenders are allowing clients to sort of to secure a rate 6 months out. And what this helps with is, even though we are looking forward to these rate decreases, we still want to sort of be cautious as well and listen to what the Bank of England is saying in terms of that the market will take a very slow recovery. And so sort of securing a rate early and hoping to then, if the rates do decrease at a later stage, we can still change your mortgage product that you have, as long as that's sort of before you've secured or before you've gone on to a new rate with the lenders. As I say, many people will find that they have to dip into their savings a bit more as they sort of face monthly costs that are much more than what they expected. Some who can also have taken the route of decreasing their mortgage. Lenders now are sort of looking between 10% to 20% per annum to allow for overpayments. So if that also helps you to, one, get onto a lower LTV, which also will mean that the rate is a little bit lower in some instances, then that would be something that we'd look at. Also, sort of increasing your term to be a little bit longer to allow for those monthly repayments not to hit so hard. A longer term on a repayment mortgage might help the client or the customers or individuals to sort of manage their costs a little bit better. I have had clients also who want to look at no early repayment charge mortgages. Unfortunately, none of those would be fixed, but there are tracker rates that are available and discount rates are available. I will note that they are slightly a bit more expensive than the fixed rates that are currently in the market, but it does give clients a certain flexibility that when rates do start to really decrease, they can then benefit from either wanting to remortgage to a much lower product at that stage. And then obviously also offset mortgages, which we don't see too many of in the market, but that allows you to basically use any savings that you might have against your mortgage balance, and you're sort of only paying the difference between that. And that's also another strategy in allowing somebody coming off their current mortgage or their current fixed rate to then pay or manage those costs. But yeah, as I say, I think it's always good to have those conversations early with the mortgage advisor, at least a year to 6 months out, especially if you're really concerned about how you'd be managing those costs. Just to have a quick look at the current rates available in the market, as I've said, those have definitely hit that 4% ballpark now, whereas about 6 months ago, we'd probably be looking at a higher 5%. So definitely improvement that we've seen in the market. As I said earlier in the year, that had gone below 4%, which would have been great. So hopefully we'll start to see these improvements, especially in the summer. And hopefully once that the Bank of England base rate also decreases, we will definitely start to see how this affects the rest of the market and these rates start to come down. The next bit that we'll be talking about are first-time buyers and sort of general challenges that they would face in the market. It's become harder and harder for them to sort of be able to, one, afford getting a mortgage, and also at the age at which people can sort of have enough capacity in terms of income and saving for a deposit. And some of the key challenges really come around with the lack of starter homes that are in the market, where new builds are sort of being snatched up by people that aren't first-time buyers, that might have a little bit more of a deposit or income, disposable income, which basically has been freezing first-time buyers out of the market. And we've definitely seen that loans over the last year have decreased about 22.4%, which is like the lowest that it's been since 2013. So we've definitely seen that the challenges of first-time buyers, or the challenges that they're experiencing, have multiplied. Cost of living keeps rising as well, and rents continue to rise. And whereas before maybe you would be able to turn to your mum and dad, they've also sort of had to face a high cost of living. And so maybe there isn't too much available or left to then support first-time buyers. So in terms of then what we could be looking at for support for first-time buyers, I would definitely say that there are lenders and the government schemes that are available that do help first-time buyers. Shared ownership scheme is one. The 95% guaranteed mortgages is another one from the government, which basically helps the lenders be able to offer these mortgages to first-time buyers, and they're sort of backed by the government for any losses, or their risk is backed. We've also seen some real innovative products come out from lenders. Skepton's track record mortgage is one of those, where basically if you have been renting for 12 to 18 months and you have a track record of being able to pay off your rent for 12 months, they would be able to consider a mortgage on 100%. And this is quite helpful because a lot of people, as I said, rents are increasing, and you might actually be affordable, or the mortgage might be affordable and maybe a little bit less than what it would cost you to rent. But because you're sort of in the cycle of not being able to save enough for a deposit, and house prices keep sort of increasing, some people might be stuck in a bit of a cycle there. So these are really great products that are available. The joint borrower sole proprietor mortgage as well, which would allow a parent, or actually now that's also actually been extended to non-relatives, to be able to go on a mortgage with the person. So that means that the mortgage, it also serves as a guarantee or a guarantor on that mortgage, but they wouldn't then go onto the title deed of the property. So the person or the first-time buyer can still sort of benefit from straight ownership of that property. And yeah, we've seen mortgages now also extend to the term of 40 years. As I said before, this allows for the affordability factor to just increase a little bit more. And then this week, Accord Mortgages has also come out with a £5,000 deposit, and allowing for a maximum loan to value of 99%. There are obviously criteria to this product. You can see that that's a 4.49 income multiple. So affordability is still a key factor that they'll be looking at, but you could get a mortgage between sort of 95,000 to 495,000 on a property value of between 100,000 to 500,000. And the max term that they'll also look at is 40 years, which for me, these are encouraging products that are coming out of the market. They're encouraging sort of first-time buyers to explore the different avenues that they can take in terms of getting onto the property ladder, and supporting first-time buyers in terms of affordability as well. I just wanted to touch on some first-time buyer rates. Just obviously, the bigger the deposit that you can get together, the lower the loan to value, and you can obviously see how that affects the rates that are currently available in the market. This is of at least a day ago, but hopefully that we'll see that these rates start to decrease as well. But at least it sort of gives you an idea, if you were looking to purchase your first home, where the rates would be. I think, again, I would reiterate that it's so important to sort of start having discussions with a mortgage advisor or myself, hopefully, in terms of how you plan to get onto the property ladder, looking at affordability earlier, looking at what, in terms of your credit scoring and debts in the background, and clearing those up. I think planning is such a key factor in how successful you are sort of in your journey trying to get onto the property ladder. And then just to sort of round up UK house prices, definitely still an increase factor on average house prices, especially since the beginning of this year when we saw that massive rally in terms of people thinking, or in terms of market sentiment around being able or to afford mortgages, and sort of the thought of how interest rates are coming down finally. So hopefully, in terms of average house costs, we'll be sort of looking at £291,000. And yeah, so we have seen that the mortgage or the house price market has kept quite strong and recovered quite well on a monthly basis. But yeah, so for now, that sort of brings the end to our presentation today. I don't know if there were any questions that you wanted to go over. Jess?
Lovely. Thanks, Nafisa. Doesn't look like we've got any questions at the moment. Oh, we've just had one pop through. Let's look at that.
I can see the question there. That is, are buy-to-let rates similar to residential rates at the moment? Yes, they are. I have started to see some rates that have just gone below that 3% mark, but the key sort of issue with that is that the product fees are quite high. So actually you might find that a rate at around the same amount as the residential rates would work out cheaper. So again, also still looking at that 4 to 4.5% on buy-to-let rates.
Lovely, thank you. I think we might have another one coming through. Oh no, just saying thank you. Lovely. Okay. Well, thank you, Nafisa, for that presentation. I am going to put the survey up now as well. So, like I said at the beginning, if anyone has got just 30 seconds of time, then we would obviously really appreciate the feedback on our side. Otherwise, we will be seeing you at the next one. We've got another webinar coming up in April. The invites should be going out for that later on today. For anyone that's signed up for the webinar today, you shall also receive a copy of the presentation and the recording. So if you've got any questions on the back of that, then please don't hesitate to get in touch with one of the advisors or Nafisa directly. Otherwise, enjoy the rest of your day.
Thank you.